It's midnight. You should be asleep, but instead you're doing what millions of Americans do every single night in 2026. You're scrolling through houses you can't afford, convincing yourself that maybe this is the year. And then you see it. A 1,200 square foot box, laminate countertops from 2003, a backyard the size of a beach towel, one bathroom, a bonus room that is clearly just a closet someone put a window in, and they want $500,000 for it. $500,000 for a starter home. And here's the part that makes it genuinely insane. The median household income in America right now is around $84,000 a year. This house costs 6 times that. 6 times. Think about that ratio for a second. Historically, a healthy home price was considered 2.5 to 3 times your annual income. We're now at 6, and it's being marketed to you as a starter home, not a dream home, not a forever home, the starting point. Now, before we go further, I want you to hear this. If you feel behind, if you feel like everyone else figured this out and you missed the memo, you didn't miss anything. The memo was fake. The math was always broken. And today, we're going to break it down together. Because here's the thesis, the whole point of this video, right up front. Banks are lying to you. Real estate agents are lying to you. Financial influencers are lying to you. And the lie is this, that this house, this $500,000 laminate countertop box, is something a normal household should be able to afford. It isn't. And today, we're going to prove it with cold, hard, uncomfortable numbers. Let's start at the very beginning. Before you even think about a monthly payment, you need a down payment. The median American has about $8,000 in savings. Not $80,000, not $80 million, $8,000. Now, every financial advisor, every mortgage guide, every responsible adult with a blazer will tell you, put 20% down. On a $500,000 home, that is $100,000. So right out of the gate, 92% of the gap between where you are and where you need to be to start buying this house is just missing. Okay, you say, I'll put 5% down or 10%. And the bank says, sure, just pay a little extra every month. That little extra is called PMI, Private Mortgage Insurance. And I want you to understand what it actually is, because the name is a masterpiece of corporate deception. They make it sound like it protects you. It does not. It protects the bank. You are paying $200 to $400 every single month to insure the bank's risk because you didn't have enough money to be considered trustworthy. This is a poverty tax. That's not a political statement. That is the mechanical function of this fee. If you already had wealth, if you already had $100,000 sitting around, you would not pay it. But because you don't, you pay an extra $200 to $400 a month as a penalty for not already being wealthy. Over a 10-year period, that's potentially $48,000 you paid for nothing. No equity, no ownership, just a punishment for starting from the middle class. Okay, let's say you scrape together the down payment. You sign the papers, your mortgage payment, principal and interest, comes out to about $2,850 a month. That's based on a $400,000 loan at current interest rates. Congratulations, you are now a homeowner. And this is where the script goes dark. Because $2,850 is not what you pay to live in this house. That's just the first bill. Here come the others. Property taxes. In most parts of this country, you're looking at 1 to 1.5% of your home's value per year. On a $500,000 home, that's $5,000 to $7,500 per year. Let's call it $500 a month on the low end. And unlike your mortgage, this number goes up. Every time the county reassesses your home's value, they also reassess how much they get to take. Homeowners insurance. The national average is climbing fast, and if you're in Florida, California, Texas, or frankly anywhere near weather, you can kiss average goodbye. We're using $300 a month. That's conservative. Climate change has made insurance companies nervous, and nervous insurance companies raise rates. Some are leaving states entirely. In 2026, this is not a hypothetical, it is a documented pattern. Maintenance. This is the one nobody talks about until it's 11 p.m. on a Sunday and water is coming through your ceiling. The standard financial rule is budget 1% of your home's value per year for maintenance. On a $500,000 home, that's $5,000 per year. That's $417 per month, every month. Whether you spend it or not, it needs to exist because the water heater doesn't care about your budget, the roof doesn't care about your savings plan, and the HVAC will absolutely choose the hottest week of August to stop working. Let's add this up. Mortgage, P&I, $2,850. Property taxes, $500. Homeowner's insurance, $300. Maintenance reserve, 1%, $417. Total monthly cost, $4,067. And we haven't touched utilities, we haven't touched HOA fees if applicable, we haven't touched the cost of furnishing 1,200 square feet that was previously empty, we haven't touched the lawn equipment you now need to maintain that beach towel yard. The real number? Closer to $4,300 to $4,500 a month to own this house. Remember that. It comes back. Now here's where I need you to sit down. If you're already sitting, sit harder. There's a rule in personal finance called the 28% rule. It says your housing costs should not exceed 28% of your gross monthly income. This is considered the safe zone, the zone where housing doesn't eat your entire life. To comfortably afford this house under the 28% rule, you need to earn approximately $174,000 a year. Not $84,000, not even $120,000. $174,000. Okay, someone in the back is saying, what about the 43% rule? Banks will approve me at 43%. Yes, they will, and that is the trap. At 43%, the number drops to around $113,000 to $120,000 a year. And banks will absolutely let you do this. They will hand you the pen with a smile, because it is not their house that gets foreclosed on, it's yours. Here's the income reality of America in 2026. Only about 10 to 18% of households earn $150,000 or more, meaning for the other 80 to 90% of households in this country, this house, this ordinary beige laminate countertop 1,200 square foot starter home is not a first step. It is a financial fantasy dressed up as a milestone. The system has convinced you that your inability to afford this house is a personal failure, a discipline problem, a you problem. It is not. It is arithmetic. Let me introduce you to the Johnsons. The Johnsons are doing everything right. 2 incomes, combined $160,000 a year. They saved up, bought the house, posted the photo with the little key emoji, got 200 likes. They are also, quietly, financially terrified every single day. Because $160,000 sounds like a lot, but let's run the actual numbers. $160,000 gross becomes roughly $110,000 to $115,000 after federal and state taxes. That's about $9,500 take home. Their house costs $4,300 per month. That's 45% of their take-home gone before they buy a single bag of groceries. What's left? $5,200 per month for 2 adults and 2 kids. Monthly take-home after taxes, $9,500. Housing, mortgage plus taxes plus insurance plus maintenance, $4,300. Car payments, no transit in suburbs, $900. Food and groceries, $1,200. Childcare or school costs, $800. Health insurance and medical, $600. Utilities, phone and internet, $400. Remaining for everything else, about $1,300 per month. Then the tires need to be replaced, $800. The bubble pops, the month is gone. The savings account doesn't move, and somewhere between 2 and 3 a.m. on a Tuesday, one of the Johnsons is staring at the ceiling doing mental math that never ever comes out clean. This is called being house poor. And here's the cruelest part. No one at the dinner party knows, because the house looks great, the neighborhood is fine, the cars are relatively new. From the outside, the Johnsons look like they made it. From the inside, they're one burst pipe away from financial crisis. And society has a name for this. It's called adulting. We have taken financial desperation, tied it to a 30-year mortgage, put a bow on it, and called it growing up. We've made the trap look like a trophy. And the reason it works, the reason people keep walking into it, is because everyone around you appears to be walking into it too, smiling, posting photos of their kitchens and their yards and their mortgage paperwork like it's a diploma. But look closer. Most of them are doing the 2 a.m. math too. So what's the answer? I'm not going to tell you never to buy a house. Homeownership, done right, at the right time, at a price you can actually afford, can be a powerful tool.
But the operative word in every single one of those qualifiers is right. The bank is not your financial advisor. The bank wants to sell you a product. They will approve you for the maximum amount they believe you can pay without immediately defaulting. That number has nothing to do with your comfort, your retirement, your kids' college fund, or your ability to replace a tire without losing sleep. So here is the only advice that matters. Stop looking at what the bank approves you for. Start looking at what you can afford while still living a life. That means, can you still max your retirement contributions? Can you still build a 6-month emergency fund? Can you still handle an unexpected car repair without a panic attack? Can you still take one vacation a year without charging it? If the house payment makes all of that impossible, then that house, right now, for you, is too expensive. It doesn't matter what the bank says. It doesn't matter what your coworker bought. It doesn't matter what Instagram shows you at midnight. There is no trophy for being house poor. There is no award for owning the most square footage you can't actually enjoy because you're too financially stressed to sit still inside it. There is no prize for telling people your home's Z-estimate while privately dreading the next utility bill. Real wealth is freedom, not equity you can't access because you're trapped by the very asset that's supposed to be making you wealthy. The most radical thing you can do in 2026, in a culture that has tied your self-worth to your square footage, is to look at a $500,000 box with laminate countertops and say, no, not yet, not like this. That's not failure. That is the sanest financial decision you can make. Run the real math before you sign anything. Your bank account, your future self, and your sleep schedule will thank you.